let's look at stocks. So the stock market has been awesome, right? I mean, we all know that, right? All of our portfolios look great. Every time you log into Account View, you go, wow, look at that, it's great. The question is, are they too high? And as a result of them being too high, are they going to come down anytime soon? And whether that's interest rates or inflation or whatever, what is going to cause that to happen? So I like this chart a lot. So this shows the S&P 500, the first year after the exact low point. So at the beginning of an expansion, the same ones we talked about earlier, at the beginning of an expansion, how much growth do you get? I'm looking at the average is 42%. This is why anyone who sells while the market is low is crazy, because you're going to miss that 42%, or you're never going to get in at the right time, and you're going to miss that huge bump. So that is the first year kind of off of the low. So don't ever sell when the market gets bad. We'll talk about like in some bonds, and how we can maybe do that a little bit more efficiently. And then in the second year, sometimes it's positive and sometimes it's negative. As you can see, the positive times, right, in the second year, average around 12.7%. Not too bad. It's not bad after a 42 year, right? But then there's a couple times it was bad. Actually, 2009 was bad, right? It was the worst one. You lost almost 20% in the second year. But the average is down around 10. What I think that this shows that I think is really important, and quite frankly, I don't know that the general public kind of wraps their head around this in the proper way, is an expensive stock market does not cause a recession or necessarily a drop in the stock market, right? Ever. It's never happened, right? Stocks have never been like so expensive that they just come crashing down. There's usually something else, that causes that to happen. And I think that's what we're looking at today. And that's the important thing is, what are these something else's? And are they going to be a big enough deal right now to kind of put the brakes on the party? Or what else are we watching for? Because if it does become a big deal, then it will put the brakes on the party. Or if it's all managed properly, right, we could get maybe closer to that 5.3-year expansion that we looked at a couple slides ago. So I like this chart. I think that it shows that, even in the second year, things can be great. And a lot of the downturns are really not that bad, right? 10%, yeah, I mean, it hurts to look at your portfolio and see 10%. But I'll tell you, none of our clients will see that. We have exactly 0 clients who are 100% stock, right? We still do believe in owning some bonds at least, and we'll talk a little bit later about how we use those and kind of rebalance them. But I thought this was great and relatively optimistic. So high stocks. Can stocks stay high? I think what's interesting to talk about what you buy. Usually when I ask people like, hey, what do you buy when you buy a stock? They say a piece of a company. Right. My mom, when I was growing up, was trying to teach me about stocks. She quite frankly didn't know that much herself. And we had gotten some, I don't know, it's like opening up a savings account, or, instead of getting a toaster, we got like 3 shares of stock or something like that. And it went to her name and, not my dad's. And it was like one of her things. So we would drive by, it was next to Somerset North in Troy. We would drive by the Standard Federal building. It was a beautiful new building. And she would say, we own like a door handle in that building because I own shares and I own a piece of that company. Right? So I think if you ask people like, what do you own when you own a stock? You might not get the door handle, but you get something like that. I own a piece of the company. I think if we define that a little bit more, right? You could say it in a different way, and you could say, I own the cash flows of that company. More specifically, I own the net present value of all of the future profits of that company. You don't own the door handle. You own the profit that those companies are generating. So that's what you're actually buying. We can look at, when you understand that, you can then say, well, let's look at price to earnings ratio and see if the price I have to pay right now is a good deal for those expected future cash flows, or is a bad deal for those expected future cash flows. So I get a little bit in the weeds here, so I know it's a little quantitative for some people's liking, but other people eat this stuff up. So sorry if you're not one of the people on this call or watching the replay that like, kind of the financial weeds. So simple, price to earnings ratio. There's something that you can calculate that is pretty popular called price to earnings. You just take the price of the stock, easy, and you divide it by the earnings per share, which you could find in 10 seconds if you care to Google it, and you come up with a factor or a number. right? That factor or number of the S&P is typically around 17. You know, from kind of 1980 till now, it's averaged around 17. Meaning that if the market, you know, if the price to earnings ratio is at 12, right, it would be a deal. That's a lower value than you'd expect to pay for a certain, you know, amount of profit over the rest of your life that you own those shares. Right now, it's not 17 though. It's definitely not 12. It's 21. Right? So again, if 17 is average price to earnings ratio, anything higher than that is like a little bit more than you would expect for the amount of profits that the companies are generating today, which is why people say the stock market is expensive. And it is. 21 is higher than 17, right? So it is. But I think if you look at what causes that, there's probably two things, and that's what the slide is about. Number one is, are these companies even generating profit? Like, are the profits increasing fast enough to support 21? And I don't know if they're increasing fast enough to support 21, but they're increasing fast. From 2020 to 2021, the estimates or the earnings per share increased 36%. These are not for little small companies like I own. These are for GM and Ford and General Electric. And I mean, that's the 500 biggest companies in America, right? The S&P 500. Even from this year till next year, you know, they went up 11% again. You know, these are huge numbers. That supports a higher stock valuation. The other thing that supports it, and I don't really think people talk about it enough or understand it, is what is your alternative, right? I might not be that great, but I'm not sure that Anna's alternatives in Metro Detroit are much better than me. So she's like pretty happy being married to me, right? Her alternatives are not that great. Doesn't mean I'm amazing. It just means the alternatives are generally worse than I am. I would say the same is true right now in investing, right? Stocks might be a little expensive, but what else are you going to buy? Are you going to go buy REITs and real estate in a world where maybe no one's ever going to go to the office again? Are you going to buy bonds that pay 0% interest? Right? So what are you going to go invest in if not for the stock market? And the answer to most people is nothing, so I might as well stick with the stock market. And that, I mean, I'm talking big investors, institutional investors, pension funds, you know, not just our client base. So they stick with stocks because their alternatives are bad. Again, that's why I said if interest rates go up, it's bad for everyone in a million different ways if they go up fast. One of those ways is the government debt gets more expensive and more of our money goes there. So now we have bigger budget deficits, which causes interest rates to go up even more. It's kind of like an upward spiral. And this is another area that is strongly affected by that. So if interest rates go up, that's actually good. And I hope that happens, but again, slowly over the next few years. So I said actually in our last webinar, I said, hey, if interest rates hit like 2.5, the 10-year treasury hit 2.5, they were 1.2 at the time. So if they hit like 2.5, that's too high, and I think it's going to kind of slam the brakes on the economy. Well, that was 4 or 5 months ago, and they're only at 1.5. So again, the 10-year treasury is when we all buy government treasuries. We lend the government money. That's how they finance their debt. They pay us an interest rate. That interest rate is 1.5 today. It was 1.2 6 months ago. And if it was 2.5 today, I'd be worried. At 1.5, I'm not. Now, the Federal Reserve is going to potentially start what's called quantitative easing, which or the opposite. You know, they're starting to pull back from their quantitative easing. So quantitative easing means is they're putting more money out there to stir up people to spend so that keep the economy going. That's what they wanted to do in COVID. Now they're going to start shrinking that. They're going to start pulling money back and saying, we're not going to give this out anymore because the economy can probably stand on its own two legs. If they do that well, and they do that slowly and over time, we'll probably be okay, right? It happened in 08. 08, they flooded the economy with money, kind of the opposite of Europe. We did awesome. They did horrible, right? So for anyone who said austerity was a good idea in 2008, you were wrong quantitatively. Europe did it. They did horrible, triple-dip recession for a decade. We came out of it and boomed and did amazingly well. They did the same thing again this time. Flood the whole system with money. Europe kind of caught on. They did the same thing this year that we did. They're doing much better as a result of that. Not better than us, but better in general than they could have been doing. So now they have to start shrinking that down. Again, last time they managed it very well. This time, we'll see. I hope they do it well. But this kind of like unwinding of the QE, of quantitative easing, this could start as early as next month. So we expect Federal Reserve Chairman Powell to probably say we're going to start tightening. It's called tightening, right? We're going to start tightening as early as October and November. Again, slowly but surely is fine. It's actually probably better because over 2 or 3 years, if interest rates come up, then this will continue happening for companies. So we might not see a booming stock market, but as companies are making more and more money, right, their price to earnings ratio will be supported because the E is earnings, right? So once the E is higher, right, then even if interest rates are higher and the alternatives look better, right, then the stock market won't get killed because it'll be a slow process and it'll be a healthier market because you can invest in bonds and actually earn 2 or 3%, maybe 4 in a corporate bond. Or you can invest in the stock market at a 17 to 18% price to earnings ratio. So again, interest rates, I think, are the big, I've been saying this for a year, are by far the biggest risk, but they haven't come up as much to cause a problem. I'm hoping that yellow line, if you remember, for that went straight down, you know, that could cause the dollar to also go down, which could then raise interest rates. That's something to watch. This 10-year treasury is definitely something to watch. How they contract the quantitative easing is something that's important to watch. So to me, these are all the things that could kill the economy. If you start taxing the average person instead of wealthy people, that's something to watch. But most of the things that they're talking about right now, I don't really believe are going to put the brakes on the party so fast that it's going to, again, interest rates worry me so much. It's what keeps me up at night because housing, I mean, now interest rates go up, housing comes down, right? Interest rates go up, more money, our deficit goes up because more money is going to finance that debt. Interest rates go up, the price of bonds comes down, the price of the stock market will come down because of what I just explained on price to earnings ratio. So interest rates coming up fast is by far the biggest problem. If that happened, we would do something in our firm kind of similar to what we did in COVID, where we would stop everything, we would cancel every single appointment, and we would look at every single client, 1,150 clients, and we would say, okay, you know, we would have, we would have all the admin people calling, all of the financial advisors, the guy that cuts the lawn, right? I mean, everyone would be calling and saying, hey, there's this huge change that's happening. Here's some things we might want to do in your portfolio.